Welcome to Mavera in Southeast Conroe. Today I'm going to give you guys a tour of this home that was recently leased out for $2,100 per month. It's a 4-bed, 3-bath home, just over 2,000 square feet, brand new construction, built in 2025. Mavera has all kinds of amenities, including splash pads, playgrounds, walking trails, and more. If this is your first time here, I'm Allie, your local Conroe and North Houston expert. It is without a doubt my passion to help people who are stuck, to educate people, to help them upgrade their lifestyles, and to help them realize what they're capable of doing and what options they really have. Because I just find that a lot of people sell themselves short just based on a lack of knowledge or information. So, as we go room by room and tour this beautiful home today, I'm going to be talking to you about the 5 most common questions renters ask me who are curious about buying. First up is the most common question I hear, which is, can I even afford to buy a house? A lot of people just assume buying is going to be more expensive than renting. And sure, it can be, especially if you go all in on upgrades or stretch your budget. But what I like to do with my buyers is flip that thinking. We start with your monthly comfort zone and work backwards from there. Let's just use this home's rent price as our example. So let's say you're comfortable with $2,100 a month in rent. That tells us a lot. That's the number we build off of because the real question isn't, can you afford to buy a $400,000 house? It's what can you buy for around the same monthly payment you're already making? And spoiler alert, in many cases, it's more than you think. That's what we're going to break down today, what's actually included in a monthly mortgage payment and what it looks like when we stack it up next to rent. That leads us to question number 2, which is, what does that monthly mortgage payment actually include? A mortgage payment isn't just the loan itself. It includes several pieces. So first we have to break that down. Principal and interest is the loan plus the interest of the loan. Property taxes, these vary by area. This particular community has a pretty high tax rate, but in our example, we'll use this one just to be consistent, which is 2.9%. There's homeowners insurance. And then if you put less than 20% down on the home, you're paying private mortgage insurance as well. Here's how those parts stack up when you're trying to hold the total at about $2,100 per month. Property taxes roughly $550, homeowners insurance about $110, mortgage insurance $185. That leaves you about $1,255 per month available for your actual loan payment, which is the principal and interest. Using a 5.7% interest rate, that's today's FHA rate for great credit, and a 30-year loan term, that payment supports a loan of roughly $225,000. With an FHA loan at 3.5% down, the total purchase price you'd be looking at would be about $233, and your down payment would be around $8,150. So you're keeping your payment in line with your current rent. You're buying a home around $233. You're putting down about 8,000, 9,000 on the high end up front. That's the power of reversing the math. You start with your comfortable monthly number and find the price point that matches it. Question number 3, what is a lender going to ask you and what do they look at to qualify you for a home? So let's say you're feeling good about a $2,100 monthly payment. The next thing a lender is going to ask is, how much do you make? Lenders look at something called DTI, which is debt to income ratio. It's the percentage of your gross monthly income that goes toward debt. And for FHA loans, they typically allow up to 50% total DTI. That means if your total monthly mortgage is $2,100, your gross monthly income would need to be double that, around $4,200 or more to qualify. And that shakes out to about $50,000 to $55,000 per year. Now, if you have other monthly debts, car loans, credit cards, student loans, those get factored in too. But as a rough rule of thumb, if you're making over 50K and you don't have a ton of debt, you might be in range to qualify. Keep in mind the ratio also varies by lender and by loan product, so just use that 50% as a rough framework for easy calculations. Question 4, where does your money actually go when you buy? AKA, what are you paying for? So when you rent, you pay monthly to live there, but you don't build any equity. The landlord handles repairs, maintenance, and most big ticket issues. This is without a doubt the one thing I miss about renting, But on the flip side, you're responsible for all of those things and the general upkeep when you own. It's yours, better for worse. And with renting, you also get flexibility, but you're not getting ownership in return. You're just really paying someone else's mortgage. Now, when you buy, you get potential tax benefits depending on your situation. Part of your payment goes toward principal, which builds your equity over time. So you're investing in a home that's likely to appreciate. Appreciation runs about 4% per year on average. There have actually only been 4 years in the last 40 some years where home values have gone down instead of up. So, in most cases, this asset is a long term wealth builder. So we've sussed out a lot of the key decision makers, your monthly budget, what that gets you, what lenders are looking for, and what you're actually buying into. But now it comes down to the big picture question. Number 5, is buying even worth it in this market? Here's the truth. Prices and rates aren't what they were a few years ago, but that doesn't mean buying doesn't make sense. If you're planning to stay put for at least 3 to 5 years, buying can make a lot of financial sense because you're building equity every month instead of throwing money away on rent. This time frame is especially important with new construction because it can be more difficult to turn around and sell a home that's a year or two old in a neighborhood where every other home is brand new and the builder's offering incentives. So make sure you sit down and think about your timeline and your long-term goals before you jump into buying. If your situation is more short term, maybe you're relocating for work or figuring out where you want to land, then renting might be the safer bet for now. You avoid closing costs, you're not locked into anything long term, and you can move more freely. So, no, buying isn't automatically the better choice, but if you're stable, serious, and you know your payment comfort zone, it's absolutely worth exploring. Thanks for tagging along with me today. Hit like if this gave you clarity on what renting versus buying looks like. Comment if any of this was new info for you, and please subscribe if you're looking for more Conroe real estate intel. If there's a burning topic you really want to know more about, please comment that below as well. I love getting questions and topics and things to guide my future videos, and I'm always happy to do a video on something that people want to know more about. Thanks so much, guys. Bye.